Welcome to the Musaya podcast, everyone. Please do hit the like and subscribe button if you are tuning in from YouTube, and do drop a comment. If you're tuning in from Spotify, please do drop a 5-star rating and do drop a comment as well. Those are two great ways of helping us spread our content, as the algorithm does favor content whenever the subscribers do so. So, anyways, you would have noticed that we did kind of pivot the focus of our podcast. We're pivoting towards producing content that's relevant to startup founders. This will be founders, for example, in the pre-launch phase and still in the ideation phase. It includes founders in the very early stages. If you're a founder looking to scale your business, looking for product market fit, this is for you too. If you're scaling your business with the ambition of, let's say, exiting your business or just scaling to a very high level, this is relevant to you too. So what we're doing now is we're interviewing startup founders at various different phases, and getting them to share their story, share their experiences, and that's one of the best way of getting useful content and sharing useful content. So recently we did interview Mark Josephson, who was the CEO of Bitly that was exited for $62 million after scaling the business. He has experience of, increasing revenue of previous companies to like $100 million. We got to interview Jared Christopher, who sold his business for $32 million to a company that eventually got valued at $1.5 billion after the IPO. We interviewed Jonathan Katende, who is the founder and CEO of LipoWorld, which is a remittance business, and they have a very innovative business model. And we also interviewed Shun Sani, who is the CEO of PayFi, which is a renter credit solution. So, the first topic that I'd like to highlight today is the issue of product market fit, right? So, according to CB Insights, 42% of startup founders fail because they haven't reached product market fit, right? And that's one of the questions that we did ask to Mark Josephson. So obviously, definitions of product market fit kind of varies among startup founders. I've heard startup founders saying that it feels like you kind of lost control of your product. So, anyways, let's listen to Mark Josephson's thoughts on the product market fit concept, and then let's come back and react to that.
Product market fit is a term that's used a lot that sometimes means different things to different people. To me, it just means, are you building something that people want and they're willing to pay for and actually do pay for? And that's a journey sometimes, because you might have a wonderful product, but the market might not be ready for it. And you might be early, or you might be late. Or your pricing is wrong, or your positioning is wrong. So it's the science of dialing in all of those elements around your product to build a successful business. And it can take time. It rarely happens right out the gate. You do have to test, experiment, and learn your way to product market fit. And that's what I think about is, what are you doing today? What are the results, and what can you learn from them that will make tomorrow even better? And that's a very entrepreneurial journey to pricing and packaging and positioning and features. So I think from an operational standpoint, I like to start simpler than more complex. When you are doing something more complex, it's harder to understand sometimes what's working and what's not from a product market fit perspective.
So you heard Mark Josephson's thoughts. The first book that came to mind was the book called The Lean Startup by Eric Ries. I hope I pronounced it correctly. I really recommend that you buy this book. I do recommend that you jump into Amazon right now and you buy this book if you're in the process of looking for a product market fit. Because this book teaches very lean approaches of building products. In other words, very cost effective. Because obviously when you build an MVP, you want to spend the least money as possible, because you want to validate the product. You want to make sure that the market wants what you're producing. I remember a couple of months ago, I was in an event that was organized by VCs in New York City, and one of the venture capitalists, which was a lady, shared that one of the things they look at is they want to see founders who understand the problem they're trying to solve very well, right? Because any product or any innovation that you build needs to be derived from understanding of the product. And as you build and iterate it, you want to build something that's going to address the problem that you're trying to solve as much as possible. So he asked the question, do people want it, right? Do people want the product? And they'll obviously want that if it's addressing the problem that you wanted to solve, right? It needs to be an existing problem. It needs to be prevalent as well. He also did highlight something that was quite insightful. Sometimes people create good product, but the market's not ready for it, right? That's something that's really important to time, and that's a tricky one. He also did highlight the issue of pricing and positioning, right? So you might have a good product, but maybe you're positioning the product to the wrong niche, and make sure that the niche is growing fast enough. And one thing to be realistic about is that it can take time. You also highlighted that, right? Product market fit is not an overnight thing, and it's not an easy journey as well. And obviously, you got to be cost efficient, because when you create a product and you want to reach product market fit, you're in the process of constantly iterating, and you never know when you're going to iterate until you find something that the product really wants. And speaking of iteration, I think someone that's quite inspirational in my circle is the man by the name of Jonathan Katende that I mentioned earlier. He's the CEO and founder of Lipperworld. From the time that I first met him about 18 months ago till now, I've seen a lot of evolution in his product. So he is building a remittance product. Well, he has built and he's consistently iterating. Initially, they did remittances of vouchers for various retail products across different African markets. So if you're in the United States, and let's say you want to send vouchers for university for your kids in South Africa or Kenya, you can send the voucher. Your child will take that code and take it to university. And just like that, the fee is going to be paid. It applies to retail stores. It applies to fuel stations, gas stations. If you want to send gas money to someone, instead of sending physical cash or cash digitally, you can also you could just send a voucher and it'll go there to them. And I've noticed that recently the product that has expanded, and they're also doing remittance of money. So the question that I asked him was around the fundraising issue, right? Because I like to ask a lot of founders their thoughts on bootstrapping versus seeking money from investors. And here are his thoughts.
Yeah, it's a good question, and I think there's a few things. It was extremely challenging, particularly in the sort of cycle of fundraising that we're in right now. But there's sort of a few things I want to highlight that are I thought were very useful for us, and one was that it's a trust game, and I think for the most part, many investors want to know whether if they give you a dollar, you can use it wisely and you won't run away with their money. So that's point number one. Point number two, I think for me, I think there's an aspect of resilience that needs to be demonstrated, and for the most part, it takes a few months to years of you constantly, chipping down at each thing. And I promise you, if I show you our initial MVP and how we started to where we are now, there's been a dramatic sort of development in the amount of time and resources we put ourselves personally and with our team members and their time. And I think once investors start to see that you won't give up tomorrow, then they're willing to back you. So I think for me, it's a fundamental of that, and having a scalable business that you can prove, whether it's through the partners that you invest or the customer base that you sort of grow over time. I think that sort of helps you. But for me, coupling all those three things I kind of mentioned, I think that's what's helped us, and we're very grateful to our investor for really coming on board and seeing this opportunity. Because it's not easy, but I urge anyone to just keep going. I think that's really the moral of the story for me.
So you heard the gem shared by Jonathan Katende, the founder of Lipperworld, on the issue of raising funds. So the 3 points were: number one, trust; number two, resilience; and number three, continuous iteration slash scalable business, right? So trust, I have a banking background myself, and trust applies to lenders and also applies to investors because you're using other people's money, right? And whether you're a lender or investor, you want returns on your investment. So you want to be sure that you develop trust with the people that are giving you the capital, right? They want to be sure that you're not going to use it to fund your lifestyle. You're not going to use it to blow something else. I've seen situations where clients have approached banks with invoices to be funded, and all of a sudden, after the money's dispersed, their lifestyle's improved, right? That's not what you want. You want to be sure that you maintain integrity. I really advise people to be kind of frugal. I kind of remember, Jeff Bezos in his early years in Amazon. By the time the company had IPO'd, he was driving, I believe, a Pontiac, quite a cheapish car. I think it's a bit extreme, but it's a healthy extreme, in my opinion, because, I'm pretty sure that investors could clearly see that the money was going into the business and wasn't funding a lifestyle. He made sure that his cost base was cheap, was low, and, a lot of the capital was going to the business. Resilience. Listen, business is not for the faint of heart. Even if you're an employee in a sales position, it's not easy to sell. How much more finding product market fit and having to sell your product? And if you don't sell, your family doesn't eat. It's a very tough thing, right? And at the end of the day, a lot of the investors want to see that you got that resilience. You're not going to give up tomorrow when the going gets tough. After some time, when they see that you've overcome certain challenges, start to build more confidence in you. I'm actually reading a book by Elon Musk. It's about him. It's the second book that I'm reading, and it talks about what he went through around the credit crunch in 2008, 2009. SpaceX and Tesla were on the verge of going bankrupt. At some point, he had to pour millions of dollars from his own account. Um, you know, he just made a plan whenever payroll time came, made sure that his staff got paid when things were getting tough. Investors were holding back on investments. Banks across the world were, holding back on lending to businesses, and he just made up a plan. And one of the investors called Garcia, that was his surname, he said that Elon Musk was the most resilient person he ever met. And after Elon Musk went through that and he held things together, the confidence in him really went up because people want to be sure that they're investing in a CEO that's willing and able to navigate through things when things get tough, because they will get tough. And continuous iteration. Looking at the example of Lippleworld, I believe that they've seen reactions to users as they use the product. They've probably interviewed and gotten feedback from users, and they made consistent iterations. They first started by, producing and selling vouchers for South African retailers. They've expanded over time to other African markets. They've expanded their range. I believe they do stablecoin as well, and they're also remitting money, right? So that's going to cover a larger base. And you want to scale your business. So you need to make sure that the niche market that you're trying to serve is big enough and that it's growing. And the other person who I really enjoy gathering wisdom on the issue of bootstrapping versus venture funding is Jared Christopher. From his background, he seems to be quite efficient with it because sometimes, a lot of founders have this idea that when you raise a lot of money, it's like the end goal, but it's not. Because if you raise too much capital, the upside is, any cost overruns are going to be covered, but the downside is the valuation because investors want the returns to be multiplied. Now, if you can raise the least money possible, it's going to be easier to increase the valuation of your business, and your shareholders are going to be happy because the return on their investment is going to be higher the higher the valuation. So let's hear his thoughts on the issue of bootstrapping versus raising funds from investors.
Having done both, raise venture money and bootstrap, self-finance businesses, or even smaller amounts of money from angels, I tend to lean towards bootstrapping and raising relatively a small amount of funding. It de-risks, the opportunity. I think the shareholders, are more likely to have a return on investment versus raising, tens of millions of dollars. I also think where technology is today, it's relatively inexpensive to be able to build software applications. So I think a lot of the businesses don't necessarily require, at least during the initial days of building a company, to actually raise, millions of dollars. So my advice to, early stage entrepreneurs is try and bootstrap or raise money from friends and family first to create value before going out and raising a much larger round. And as you start to raise more capital for business, it really changes the whole dynamics of operating a company, obviously reporting to shareholders or potentially a board as well. So my advice is, if you can bootstrap, if you can self-funding or get funding from your customers, ideally, that would be the preferred way to grow.
Knowing Jared personally, he's a very practical and pragmatic person, so I know that what he's saying is not BS at all. And look at his story. You find that his previous business, he did raise about $2 million, but before he did that raise, he bootstrapped the business, and then eventually he scaled the business. He had like 500 customers that were businesses, and the product reached over 2 million consumers, if my memory doesn't fail me. And he managed to sell the business for $32 million, which is 16 times the amount invested, right? So I'm pretty sure that his investors were pretty happy because, venture capitals, angels, whatever form of investor wants to have multiple returns on their investment because it's very high risk. It's very different from investing in a business that's already listed in the stock market, where we already have like fundamentals to analyze to predict how they're going to perform. In this case, you're really betting on the founder. In this case, Jared already had experience of building, scaling, and exiting businesses. So he highlights the importance of starting with, a friend and family round, right? I'm pretty sure that a lot of you listening do have friends and family that you're comfortable with to have such a conversation with. I must admit that in my cultural context, I'm not too comfortable myself. So I kind of resort to my own pocket for, initial bootstrapping, and if possible, to see if my co-founders and partners are also able to put some skin in the game in the business, right? He also mentions that bootstrapping also de-risks, because from a governance perspective, you're not reporting to anybody. You're able to experiment because it's your money. You're putting risk on it, right? Or your friends and family's money. Because when you now have money from venture capitals or investment institutions, there's now a different dynamic. The governance changes. You're now reporting to people. There's going to be a board that you're going to report to. You got to be accountable to them. And you got to make sure that you're aligned with them, because there have been cases where founders have been fired. Back to the example of the book about Elon Musk. It gives the example of the founder of Tesla, right? And initially, Elon Musk was one of the investors that they approached, and he eventually had a part in sacking the initial CEO because they weren't too happy with, the manufacturing issues that were arising and some of the faults that the product had. And he got in and he eventually sorted that thing out. And he also highlighted the fact that nowadays it's cheaper to produce software products, right? Because there's so many tools available, there's so many startup communities available. The economy is more, I would say, prosperous than it was in the 90s. I mean, in nominal terms, there's more, investment capital available in the country, even though it continues to be a challenge. Above all, it's really good to have all these principles in place, all these techniques in place, all these lean startup techniques of building products in place. But if you don't have the spirit, man, you know, things won't work. I've heard many times, entrepreneurs being asked whether entrepreneurship is for everybody, and they do vary. Some believe that some people are built to be entrepreneurs and some are not. Others do believe that anybody can be an entrepreneur as long as they have the grit. So, in closing, I'd like to go back to Mark Josephson's comment on the importance of grit and hard work as a startup founder. I remember he even said something that my university professor told me. He said, "There's no substitute for hard work." Let's listen to this clip as we close.
Number two is grit. It's what you do when you don't win every day. You will not win every day in life or in entrepreneurship. So when you're feeling the least optimistic, or the signal is the worst, or it is the hardest, that's when you have to have the grit. Grit is the willingness to get back up and keep doing the work. And the third thing I would say is a tireless work ethic. There is no substitute for hard work. There is no magic bullet. AI is wonderful. Automation is fantastic, but everyone's going to be using it. So when I look for when I meet entrepreneurs, I'm always looking to see, are they optimistic? Do they believe in the possibilities of what they can create? Are they willing to get hit and get back up? And are they willing to do the work?
You just heard the word of someone who sold his business for $62 million. There's no substitute for hard work. You're not going to win every day. It's not going to feel good every day. You know, from his experience, from his body language, you could tell that there were times when things really got tough and only the tough got going. And he had to, like, something beyond, motivation for money pushed him forward. And that's what everybody goes through. I remember in university sitting across the desk from my supervisor who was supervising my dissertation, Sanjay Soni. I did honors in small business development, entrepreneurship. He told me the exact same words and they stuck. He said, there's no substitute for hard work. Everybody that's winning and succeeding went through hell. I mean, the book by Elon Musk that I'm reading, it's the second book about him that I'm reading, and it's the second time I'm coming across the time around the credit crunch in 2007, 2008, when Tesla and SpaceX were on the verge of going bankrupt. At some point, he was struggling to raise capital from investors, and he almost had to choose between pouring money into SpaceX or pouring money into Tesla, which would mean that the business that he poured money into had higher chances of surviving the crisis, and the other one would go bankrupt. But somehow we found a way to allow both businesses to survive. And the confidence that his investors had in them really went up. So anyways, I hope that really stuck with you. I hope this blessed you. And please don't forget to hit the subscribe button. See you in the next episode, and God bless you.